Hi, am I audible? Okay. So, welcome to our press conference for our results for Q2 2026. Um, uh, we have our top management here on the stage. And to begin with, I'll invite our MD and CEO, Mr. Ashish Pandey, sir, to give his opening remarks.
Sure. Good afternoon. Am I audible? Good afternoon to everyone. I extend a warm welcome and sincere thanks to all of you for joining us today, this press meet. We had our audit committee board, so other formalities, and we are with the working results. So let me, before going to that, let us see what are the macroeconomic environment as of today. So it is just a brief overview as a broader, environment. So there are global economic conditions, some disruptions. So there is some sort of an uncertainty over the supply chain, over the currencies, and also on the tariff side. So these are the volatilities on the domestic front. The key macroeconomic indicators are good, supported by policy interventions, as we see our regulator being coming out at the intermittent level. So it gives an the outlook is optimistic, which we are seeing from the market. We see the GDP growth. So all of us, we know that our country, we are the youngest, very young population, good demand, domestic demand driven economy, and that is the reason which we are all trying for an Atmanirbhar Bharat. So if we see the IMF expectations, the projections is around 6.5 to 6.8 levels. And our own, we have our own estimates from the economic side. So we believe somewhere 6.7 to 6.8 range, which is on the real GDP growth. So I think that is again on the positive side. So we are seeing, the buoyancy in credit, particularly more in the infrastructure, but then also in the manufacturing side. So with this, I think the broader outlook. So on the economic front, on the world perspective, on the domestic front, and our own banks and how we see the economy moving forward, and practically what we see as a banker from the society side. So there is a good sort of a demand even in the retail side. So these are the positive signals. Now coming to the bank's performance overview. So before I come to the bank's performance overview, so first of all, I really acknowledge and appreciate my two important constituents of the bank. The first is the customers, whose vintage, lineage has always helped the bank, to build strength day by day, and for which the Union Bank is known for. So that is the positive side. So on both the sides, though there were certain challenges, but then bank has stood fast, and the customers has stood along with, and the bank has gone strength to strength. The second is the bank has focused on a sustainable growth. So that is the key point, and balance is maintained from the top line expansion and bottom line strength. So I think these are the two key points which the bank is looking at it. Now, coming to the key financial highlights, I will just before our CFO takes over as a presentation in front of all of you. So before that, the net profit, if we see, the net profit for quarter 2 FY26 stood at 4,249 crore, marking a QOQ increase of 3.25% and YOY decrease of 9.7%. So for the first half of FY26, the net profit reached 8,365 crores. So this is the quarter and the 6 months figure on the net profit. So if we come to the operating profit, the operating profit for Q2 FY26 stood at 6,814 crore. So and the operating profit for half year FY26 is around 13,723 crores. So profitability ratios, if we take the return on asset, is stood at 1.16%, and the return on equity is at 15.08%. The capital adequacy, the CRAR remains one of the best in the industry, which is 17.07% with CET1 ratio of 14.37 percentage. So which is a better comfortable level above the regulatory minimum requirement. The asset quality bank, as I said, has focused well on various counts past 3 to 6 months, but the impact is there now is coming, which is the gross NPA reduced by 107 basis points YOY to 3.29%. The net NPA declined by 43 bips year on year to 0.55. So the provision coverage ratio PCR stood at 95.13%, reflecting a well-provisioned balance sheet of the bank. Now coming to the credit cost, while I am giving some figures on the asset quality, so let me also come on the credit cost and slippages. The credit cost stood at 22 bips for quarter 2 FY26, so which was 109 bips in quarter 2 FY25. So there is a much better improvement in that. The slippage ratios was contained at 0.91 percentage in quarter 2 FY26 compared to 2.40 in quarter 2 FY25. So the gross slippages for half year, yeah. Come again, please. So we will be giving in the presentation. So just as a narrative of the key figures, the key performance of the bank, I'm just narrating. Once I think shortly it will be over, and then our CFO will be coming through the presentation. The business growth and strategic priorities. So as far as the business growth is concerned, the credit growth of the banking industry moderated. So generally it is on the banking industry, which is moderated over 11% in 25 to 10% in half year 26. Similarly, deposit growth for the industry, this decelerated from 10.3 in FY25 to 9.9 in half year FY26. Actually, we have also decided to protect our margins. So if you see, we have tried to contain the margins and the NIM and the other efficiency parameters, and we have curtailed actually high cost bulk deposit mobilization in the rising interest rate environment, and there is a reduction in high cost bulk deposit by 21.85% YOY in September 25. So this was one of the key decisions where the bulk deposit, which was on high cost, the bank has better moved to shelve it, so that the margins are actually contained as expected by the management. So total deposit grew 1.90 YOY and advances registered 4.99% growth YOY. So these are the two figures. And if we take, so as again I said, the bank is now considering the sustainable business, number one, and number two, the business which gives a good profitability. So on that front, I would say the retail term deposit plus CASA grew by 1,03,000 crore YOY. So this is one better figure, and the retail lending has grew by almost 24%, precisely 23.98% YOY growth. The MSME, which is also the focus at present, as I said, for the Atmanirbhar Bharat. So MSME lending is around 14.88% growth. The strategic business mix which any bank considers is which we were moving up till now is retail to bulk deposit at 75 and 25. So we want to contain, that is the why we are moving around 75 to 25. We will try more so to shelve down the bulk deposit going forward, which is at higher rate of interest. If we take the RAM and the corporate, the strategically it was 55-45, but then the bank is endeavoring to increase the retail. So I would say from this 55 to 45, better to take plus minus, not on the plus side, but then plus 3%. So I can say going forward, the focus is on more on the retail side. So, and because when the corporate books doesn't give much of the leverage on the margin side. So this is right now 55 is the RAM and the corporate side 45 is the strategic, but you will have the exact figures. So it is lesser than that, but then our focus is more of a retail and diversified portfolio on the loan book. So this is the, I think, is the key figures I would like wanted to share with all of you, and I would request our CFO to just give the key figures as you may be keen to know on the annual basis, and also comparison with the prior year periods, maybe even quarter to quarter or maybe half year to this. So then we will have a question and answer, and we will be happy to satisfy your queries post this presentation. Thank you. Thank you.
Yeah, so we will now just move to the presentation. I will not focus, we will try and spend the next, around 15 minutes on this presentation. So I will not look at the, the generic slides, we'll just get into the numbers. If we move to the next slide, the next slide is giving our, how our operating performance is. Like we said in our press release as well, our deposits have grown by about 1.9%, but more importantly, there was a conscious effort to reduce our bulk deposits. So if you look at our bulk deposits year on year, they have reduced by about 80,000 crores. So therefore, if I just look at my retail term deposit and if I look at my CASA, that has grown 12% year on year, and on a quarter on quarter basis, it's grown by about 3%. So it just gives you an indication that there was a a conscious attempt to reduce our high cost deposits. If you look at our advances, it's at about 5% year on year, and we'll get into the various segments in a separate slide. RAM continues to be an area of focus, like was mentioned earlier, and we have grown at about 8.2%. Capital adequacy continues to be strong, 17%, and therefore we don't have any concern on that side. Gross NPA, net NPA continue to decline. So if you look at our gross NPA, it's 3.29, so 107 basis points decline year on year, and our net NPA has declined by about 43 bips to reach 0.55%. PCR continues to be very strong, again 95% PCR. Operating profit 6,814 crores, net profit 4,249 crores. Margins for the quarter is at 2.67. If you look at a 6-month basis, it's 2.71%. So it's in line with the guidance that or the indication that we had given in the last analyst call. Credit cost this time is low, 0.22. If you look at the 6-month period, also it's trending quite nicely, and that compares very favorably as compared to last year. And then finally, in terms of the profitability metrics, they continue to be strong. ROA is at 1.16% and ROE is at 15.08%. If you move to the next slide, this is just showing the worm in terms of how our operating profit has been moving. So operating profit, as you can see, 6,814 crores, more or less similar to what we declared in the June quarter. Net profit has improved, and that's because there's been a decline in the provisions. Net interest income is, is on the lower side, about roughly about 300 crores. And that's a direct impact of, some of the rate cut implications, impacts which came in fully in the second quarter as compared to the first quarter. ROA continues to be strong, 1.16%, ROE at 15.08%. So it's in line with what we've been mentioning, that we will, look at an ROA which is above 1% for the full year. So, last quarter was 1.11 and this quarter is 1.16. ROE, again, both the quarters we've declared an ROE of greater than 15%. So 15.15% and 15.08%. If you move to the next slide, that's giving a gross NPA. You can see a declining trend. So the ratio continues to improve. It's at 3.29% for this quarter as compared to 3.52% in the last quarter and about 4.36% a year ago. Net NPA again is at 0.55% as compared to 0.98% a year ago. PCR continues to be strong. We've improved further in terms of our PCR. It's now at 95%. Credit cost, we've had some write back of provisions. So therefore, this quarter has shown 22 basis points of credit cost. And for the 6 months, we compare quite favorably as compared to last year, 0.34% versus 0.91% in the 6 months last year. Slippages remain under control. 0.91% is our slippage ratio. The next slide gives you an indication of how our credit portfolio has been performing. So like we said, the focus continues to be on RAM in terms of the 55-45% mix. RAM is at 57% for this quarter versus 43% large corporates and others. If you look at the growth, right, retail has shown a growth of over 24% year on year. Quarter on quarter, it's at about 4%. MSME has also shown a good growth, about 15% year on year and a 2% growth quarter on quarter. Large corporate is, kind of flat. And that's because, we found that, some of the rates that our clients were requesting us for were not giving us the right metrics. And like we've been mentioning in a lot of our conference calls, we continue to focus very actively on the metrics just to make sure that from a ROA and ROE perspective, we get the right kind of return for our stakeholders. Credit deposit ratio, the CD ratio, global is at about 79.6%, domestic is at 77%. Next slide. This just shows the 57%, how it's broken up in terms of the retail, agri, and the MSME portfolio. 42% of our retail portfolio is home loans and about 10% is vehicle loans. Next slide gives you, next slide. Gives us the industry profile. So not much to comment, but as you can see, we are lending to the, in terms of the ratings of our corporate loans, you can see that most of it, in fact, 94% is BBB and above. And even in terms of the NBFC exposures, more than 99% is A and above. Next slide focuses on our deposit growth. So while, it's showing a year-on-year growth of about 1.9% and, a kind of a flattish quarter on quarter. But, the story behind the numbers is that we consciously brought down our bulk deposits. And therefore, if we had excluded this, our deposits would have been about 12% up year on year. And in terms of quarter on quarter, it would have been about 3%. LCR continues to be strong, 127%. NSFR is at 117%. If you look at our ratio of CASA and retail to bulk term deposits, it's at 77:23. If you move to the next slide, investments portfolio steady, 3,47,000 crores. About 75% of that is SLR. The balance is non-SLR. The next slide is giving a P&L. So you can see that, on a quarter-on-quarter basis, I'll first focus on the quarter-on-quarter numbers. So, the net interest income is down 3%, like we alluded to, more driven by the interest income, which is down, which is reflecting the repricing of the loans, because If you look at our loan composition, about 51% is EBLR, 39% is MCLR, and the balance 10% is fixed rate and others. So that actually plays out in terms of the 2.36% decline. Non-interest income 11% up quarter on quarter, and that is strongly backed by our fee-based income, which is up 10%. One of the components contributing to that is the processing charges. Treasury continues to show a good performance. Obviously, last quarter was a very good quarter as far as treasury is concerned, but this quarter again we've declared a profit income of about 1,000 crores, which compares well with the September 24 quarter. So to conclude, the operating profit for 3 months is at 6,814 crores, which is almost like, it's about 1.3% down as compared to the last quarter. It is obviously down as compared to year on year, and that's because last year for the same quarter we had a good amount of recovery. So you can see that there's about 500 crores, reduction in terms of the recovery that we had year on year. And net profit, because our provisions are on the lower side this year, we've had some write-backs. And that's why our net profit is at 4,249 crores, which is up 3% quarter on quarter. The next slide is showing provisions, so you can see that. We've taken some provision for standard assets in this quarter as well, as something that, we want to, it serves two purposes. One is it also helps us build up the buffer towards ECL. And secondly, it's also something that, we're trying to look at in terms of, if we are seeing that there could be a potential for an incremental provisioning on NPAs in subsequent quarters, then we're just, providing for that on a conservative basis. Tax continues to be, steady. Our ETR is roughly about 21%, and that's similar to the last quarter. Credit cost, as like you see, is at 22 basis points as compared to 47 basis points last quarter. If I look at the key ratios, cost of deposits, it's improved in this quarter. So you can see that it's down by about 5 bips as compared to the June quarter. If I look at the yield on assets, that's taken a higher hit, so it's about 16 bips down. NIMS is the last thing on that slide, which is showing that for Q2 it was at 2.67%, and in the June quarter it was at 2.76%. But this is high. We had mentioned that our NIMS for Q2 could be in the range of 2.6 to 2.65, so it's higher than what we had indicated in our analyst call in the last quarter. For 6 months, it's at 2.71%. The next slide also gives us our cost income ratio. So cost income ratio is showing an increase in the September quarter, 50.6, but that's also because we have tried to balance out the expenses over the year in terms of taking some incremental, like in the last year we had taken incremental actuarial valuation provisions, AS15 provisions in the last 2 quarters. What we've done is we've actually spread it out across the year. So that is why if you look at it on a full year basis, we are comfortable in terms of where our costs are trending. If you move to the next slide, this is just showing the movement of NPAs. Not much to comment here. Like we've said, our gross NPA is 3.29% for September, and our net NPA is 0.55%. PCR is at 95%. Recoveries is also mentioned over here. Our total recovery is about 3,621 crores in this quarter. Sectoral asset quality, you can see that in terms of sectoral NPAs on the right hand side, it's kind of consistent with what we've been declaring in the previous quarter. So retail sectoral NPAs are 1.1, agri is at about 8.5, MSME is about 4.42, and LC and others is at 2%. And then to end my presentation on the numbers, we'll move to the last slide, the next slide, which is capital adequacy. So like you can see, capital adequacy continues to be strong, 17%. We have a board approved capital plan to raise 6,000 crores if required, because we have some bonds maturing this year. So we will take a call on that as and when required. Currently, we don't need that because, we have a very strong capital adequacy ratio. So with that, I end my presentation, and we'll now throw it open to questions.
Hi, this is Ankur Mishra from ET Now. First of all, congratulations for the result, and Mr. Pandey, to you as well. I'm talking to you first time after you have taken over, so congratulations on that front as well. To understand the earnings more, you mentioned two things: sustainability and profitability. I want to understand in terms of actions. What are you going to do? I mean, what is your plan here? Will you be focusing only on the margins front that they should be lucrative enough wherever business you are doing? So, can you explain on that front? In terms of results this quarter, there is a 10% dip if you compare with last year. Uh, where it is coming from? Is it more due to operating expenses? You also mentioned about the change, how you're provisioning. Is it due to that? So which are the factors which are contributing to that fall?
Okay. So first of all, as you asked about the sustainability of the business and the maintaining the margins which we expect. So strategically we were thinking of 45 on the corporate book, and then the size of the balance sheet of the bank is big enough. So there are combination of when we talk about the corporate book particularly, because retail is more or less very much shielded as far as the competitiveness in the market is concerned on the home loan and the others. But coming to the corporate, you have a lot of bandwidth to play with from the short-term loans, or maybe the triple A related loans, and maybe where the government guarantees and other things are there, which is a bit very cheaper rate. On the other side, you have the very good loan book, or the demand in the market, where the rating is somewhere triple B plus, and A minus somewhere sort of, where you have some margins as well. So which again depends upon the way in which you are taking the lineage of the corporate book relationship. Now there are again three parts: one is the large, another is the mid, and another is the MSME. So the bank is certainly going for a quality MSME is number one. So certainly it is order of the day as far as the economy is concerned. The second is the mid corporate. So there also the bank is having already done the required infrastructure, which is verticalization. So there itself, there also the margin you get. Even in the large corporate book, the bank is consciously scrutinized, and there we are thinking. So probably there are two things will happen if you see. The one is the changeover within the book, where you are moving from a bit low to a bit higher sort of, and the quality maintaining good at the same time. So it will not give you the straight away impact on the growth, but then it will be a good impact on the positive way. The second is that where there is some portion where you have a part of the thing, on the CD ratio, I would say, or excess SLR, where you can build the things from treasury to the loan book side. Because the treasury yield typically you will see a bit lower. So it is managing your book between treasury to the point number two specifically I am talking about is the within the loan book, where you can shift from the lower yielding to a better yielding while maintaining the same quality. The third thing is that since you asked about the sustainability part, the bank is also focusing. So we are creating our own strategy document. Probably will be more by the next quarter when we discuss with all of you. Where it will be like the location based. So bank is coming with the cluster schemes on MSME and all. So it will not like the cluster which we say like RBI. It is a broader, but then even specifically in the pin codes in a district. So it is we are working upon that. So the business continuity, sourcing of the business, quality business, underwriting of the same. So it depends upon from right from sourcing till underwriting and servicing. So That is where sourcing we are going. Now coming to underwriting part, we are also in talk with some of the agencies where we can automate with the outside data and internal data so that the TAT becomes faster, because today TAT is very important. So while sustainability we are talking about the how business continued business will, so that that will give a growth from which pocket, because there are certain sectors in India where the things are moving very right. The people are there who are doing private expenditure on the capital side, and there are even the industry reports are good on those sectors. So those sectors, this is what we are covering. So on that part, and now change in the provision, something it was required on 2-3 places where the zero coupon bond or the low coupon bond. So there was a requirement as far as the perception and understanding of it was concerned. So that is what we have provided this time. And there were 2-3 accounts where we were supposed to provide. So around almost 850, 900 crores we have already, entirely we have done, one was for all.
And on the growth front, when you say sustainable growth and also at the cost of profitability, how much growth you are comfortable, how much growth you are aspiring for the current fiscal year?
Yeah, see, the 6 months are already over, and we are into the business season right now. So the time left is 6 months, and few challenges were there. It is an acceptable thing, which is, but at the same time, that is why I appreciated the customers and the staff members of the bank, where really they have bounced back and come back nicely. And see the growth also. So next 6 months, if I will see if we can take the GDP, like which is moving around, say safer side 6.7 to 6.8%. So taking into, so from here onwards, you can see the growth of around 8 to 10%, and then average wise it will be certainly, because 6 months are already gone. But then for the bank there are two things. One is the top line and another is the bottom line. So as I said, the expansion of the top line, but the strengthening of the bottom line. So that is where we are working on both, so that finally the investors will look into what is the kitty which is growing in the bottom line. So we will be maintaining both and be cautious about on both the fronts. And I think the focused strategy across, I would not only say that the retail on the asset side, but I am also saying you on the liability side, because we are very cautious now and concerned that CASA we would like to increase by 1.2%. So going quarter to quarter, the entire efforts will be to increase the CASA, because this is one of the concern which the investor is also having, and we are cautious about it, and we will be improving upon that. So on that also action is on the place now. We will be implementing it. We are implementing it, and going forward, you will see that the CASA position improves. So that will also shield me some margin. So I think there are not one strategy which is working it out. So I think the 4-5 strategy with the board, guidance of the board and the honorable members of the board, which we have discussed. We have also discussed with the field people. So we had a conference, so where we have taken input. So both, I would say, top down and bottom up approach. So we have arrived at the certain action plan which will be moving forward.
And on the NIMS front, can we expect even better numbers despite the pressure on the rate?
See, there are two things on the NIM front. One is, what is your book on the MCLR, and another is on the RLR. So if we take the already, more than 100 basis point, it is already hit, is there on the report. Now going forward, what is going to happen? See, the repo is impacted immediately on the credit side. On the deposit side, if you see, even we have a concern, that there is a lag from the deposit pricing and the impact of the repo reduction. So what I feel is that this impact certainly, and this was the reason that cautiously we have shelled down the bulk deposit intentionally. So going forward, we also expect at least to continue with the same range or better rate. Let me tell you very frankly. But at the same time, if there is a reduction in the repo and then that impact. So the first strategy will be how to minimize that impact, or can we defend it at the same level, and then the third position is how to improve upon the same level. So I think I would like to say the 3 points name. In case there is a further reduction, then otherwise from here, our only the second two which I have told to you. The one is how to better the NIM from here onward. First is defend, and second is how to make it.
Good afternoon, sir. Manish Suwana here from Money Control. Sir, I have two questions. First question is on the provisions on the standard asset. As CFO sir mentioned that it is for the buffer to ECL. So just want to understand that how much buffer you will be required in overall as of additional provisions, whatever you have already provided, and every quarter how much you are going to provide it. And my second question is on the PSB consolidation, because there's a buzz going on since PSB Manthan, and Union Bank's name is been discussed with some other bank. So can you throw some light on that? What are the discussions happening with the government or with the DFS or any other thing?
So I think I would request my first part, and second part I will try my level best to answer.
So on the ECL side, right, it's not new in the sense that we have been estimating ECL every 6 months, and we've been even reporting to the Reserve Bank every 6 months. So we're quite comfortable in terms of the gap. The gap is not in the public domain, but it suffice to say that for instance the latest draft guidelines from the RBI gives us 5 years to take the hit, but we will take it in. Our intention is to take it in a lesser number of years. So we are very comfortable in the gap. Currently, the gap is not in the public domain because firstly the guidelines are draft, and we'll have to wait the final guidelines to actually see what finally materializes. But we are very comfortable. We're not planning to take provisions every quarter. That it's just that this quarter we felt that there would be some requirement. That's the reason why we've taken. But it's not that every quarter we'll be taking.
Is there any number, estimate number that this much provision you have to make it?
We have an internal estimate, but that's not.
Give us that number, that what exactly that number is.
And none of the banks are disclosing that.
And, there are some banks who have disclosed.
But we've over the last 2 years we've not disclosed that number because that number is an evolving number because we're commenting on draft guidelines.
He says that we are comfortable with complying with the ECL guidelines when it comes in the final. I think that is sufficient.
Yeah, and I'll just add to that, we're working with two external consultants, so we've also got the systems in place, we've also got the methodology in place. So we're quite, and we have a parallel system running in terms of how ECL should be computed automatically. So we're very comfortable in terms of the way it's evolving.
See, as far as the draft guidelines are concerned, and now you see the capital adequacy of the bank, we are at a comfortable situation to mitigate this ECL. So I think that is not because since it is a dynamic situation and what final will come and how it will be implemented, how much quarters will be given, then it depends upon the situation whether you are absorbing bank to bank, whether you are absorbing on the one go or you are spreading it out. So I think it will evolve, but at the same time with the capital adequacy position bank is in, and last 2 quarters what the profit bank has declared, I believe is an okay position. And I think the second question which you asked is very typical, but then on a lighter vein, we are also hearing from you only because you only make the news. So, but at the same time, yesterday there was a one-month summit in the GEO and our DFS secretaries are also there. So there are things discussion, but let me tell you as an individual bank, any such discussion doesn't happen like this. So directly or indirectly, like what all of you put into, we also hear something like that. But as such, but now coming to earlier one, if you want, as an economy, as an the consolidation which we had earlier, I would say it was like State Bank and the others, then the BOB and DENA, and the last one, And it was a tough situation during the COVID period. But then there is a successful and there is unsuccessful stories. So the things are evolving and how the market, it is a dynamic market, where the market decides that what is going to happen. So like if you see the RRBs, one state, one RRB. So why it has come? Because the users, the customers of the rural India wanted that RRBs should be, they should get more products, they should be digital. So now RRBs are offering mobile banking, internet banking, WhatsApp banking, what not. So it is the situation that demands things to evolve in the free economy. I think that things are there, and to that extent we also know.
So basically, there is no official communication from the government. It is just in the air.
No, sir, there is nothing. We also hear, that is what we hear.
Just wanted to clarify, Joel from the Economic Times, you said 8 to 10% growth expectation this year. Will you stick to that forecast given the growth numbers that we are seeing?
See, the aspiration is that
Ah.
because we are poised with the products. The team has worked with some innovative products, some and the strategy to penetrate some pin code location wise even. And the third is that on a specific, suppose the current where the strategy should be on the savings side, and in the similar way on the retail side. The corporate also, the focus is there with the department. So I believe going forward, our aspiration is to move much better on that side which we have indicated, and we would like to adhere to it.
I mean, will you be able to achieve it, or are you lowering your expectation for this year, given what has happened in the first two quarters?
See, we are expecting that, but let us see how things evolve, because almost.
Yeah, and just to add to that, we've not given any guidance consciously in this year because of the volatility in the global market itself. So it's very difficult to give a number. But what we're saying is that we have been working internally in terms of the way forward, and we'll see what is best possible, and those are the numbers that.
The retail grew 24% year on year. Will that pace continue of growing retail, and large corporates are not growing as much? So will that trend continue for the rest of the year, given the situation?
See, I believe we are in the busy season, so the portfolio, depending upon the guidelines, like on the RAM sector, in between MSME, retail, and the gold loan is also one of the portfolio which determines on the agriculture retail side. But yes, put together, I will say, there where I came, when the RAM 55 to 45. So where we said that 3% on the RAM side more. So we can expect that RAM should be more better. So for achieving that, we would aspire to be have very good growth on the RAM side. And
So
retail will lead to it along with MSME.
So RAM will be 58% by the end of the fiscal. Is that what you're saying? From 55?
No. We want to be better. Like the corporate book will be a bit lesser.
We've said that
RAM will be more.
We've always said 55-45. Currently it's 57-43, but our aim is a 55-45 itself.
Yeah, I think 58 what he was saying is correct. Correct. Why you were correct, Mr.
So 50.
Yes.
50.
Yes.
Can we take queries from this side? Good afternoon. We had asked question on the net profit of 10% YOY. Is it because of this specific additional provisions that you made? That was the reason, or what is the?
No, the YOY, approximately about 450 crores of reduction. That's because, like I mentioned in the presentation, as far as recovery from our written off assets is concerned, that's down by about 500 crores. So that's what is primarily contributing to the decline in profit year on year.
Second is on the margins, NIMs across the industry, right? But all of them are giving, sounding or signaling that is now much of work is over because of repricing of the loans is through and repricing of the deposits is underway. For your bank, in what time frame it should get over, and then you could see the improvement in the NIMs. Even
See,
the RAM also you're rejigging your
Yeah,
share.
so I think if you see that we have today also average around 21.85% bulk deposit is shelled out. So certainly this would have been into the August and September mostly, not exactly in the July. So now you will see this quarter will be a full impact at least for this portion. Now we will be taking some more steps similarly in this quarter. So that will be additional. So going forward, when you shell out the deposit of the high cost, so it gives a much of a relief. So I think that is the first point, and second is it is a the positively coupled when slightly you rejig from your loan book portfolio for a better margin sort of, or maybe you move a part of a treasury to the loan book for a better margin. So it will couple, and probably that is why we are hopeful it will be better, subject to if the same trend continues.
Give some indication margins where by end of March it can be.
Because it depends upon the trend in the repo. So that is why I gave the three things when Mr. Ankur asked. The first one is very clear that in case if it is reducing, then the first is the defend the same level, how to an extent. If impact is coming, how to minimize that impact. And third is how to better it. So I think these three strategy prolonged we are working on.
Another is the request, this kind of arrangement, if you could review it, because we are at distance and we are at our, normally it would be better if we are, so that we are able to see you and also the presentation can be slightly better. Or if you want to continue, then call us for all the internal meetings. This arrangement will be good for us.
Sure. Well received.
Hi, sir. Kabir here from Infamous Media. Sorry, here at the back.
Okay.
So I have two questions. First, regarding how you've given your aspiration for growth in advances or overall business growth. Will you also be able to share with us what will be your aspiration in terms, strictly in terms of deposit growth for the rest of the financial year? And secondly, I have a question regarding the investments. So the SLR is down by about 25,000 crores. CDs are up by 5,000 crores. And investment in mutual funds is up by around 10,000 crores. So just want to understand that is the bank shifting to more towards financing loans from capital markets or markets rather than taking the traditional route of deposits?
No, exactly it is not like that. So your first part I will take, when you asked about the deposit. So when you asked about the deposit, certainly the bank wants to increase, as I said in my earlier, queries from one of the press official, that we would like, to increase our CASA on quarter to quarter basis. So that is the first thing. Second thing is that when you are reducing the bulk deposit, like I said, 21.85%. So I think then the CASA plus retail term deposit is increased. That is what I said in my opening remarks. So whenever you shift or you make a change within the portfolio itself, it doesn't give a growth, but then there is a quality which is coming in forms of margin. Now what you asked is the CD ratio. So the 78 generally to 80% is good CD ratio. So to this for September 30th we are 79.67. So we are maintaining good CD ratio. So I believe that we will continue. What is the requirement of the deposits? Because when you come to the sources of on the balance sheet, on the liability side, so I think there are various ways to continue, but we'll continue with the deposit growth wherever required in the same range as I said for the credit, but with the caveat that we have the CD ratio of around 79 to 80% rate. We'll continue on that, and whatever is required, we'll continue. But our focus will be more on a retail term deposit rather than the bulk deposits.
Understood, sir. Actually, my second question was, maybe I was not clear. I was talking about certificates of deposit.
I'll cover that. So basically, it's more a question of fund management. So if we find that, CDs are at a better rate as compared to bulk deposits, we'll obviously move to a CD. If we have excess SLR, we may want to reduce that if, there is not, adequate advances to, so we would rather deploy it in better yielding assets. So that is the reason why you're seeing that.
That is not a lending to capital market,
Yes.
it's only investment. That is short term we are done it.
Yeah.
Is that going to continue? Are you?
So fund management, it's a daily fund management. It's a daily, it's just so happened on.
See, sometimes what happens, when you are taking the deposits, suppose if I am saying X%, now suppose CD market is X minus 0.20. So it is better for me to raise the money at the lower rate rather than the higher rate. So it is purely fund management rather than any sort of. And what happens, I will put you differently two things. The one is that when you take the deposit, what is the maturity? CD is generally for the 3 months. So even if you are shelving it out within the next 3 months, you have a very movable opportunity to reinvest or you retake it, deploy it. But at the same time, if you take 1 year, you are stuck up with that rate if it is on a higher side. So I think it is only a purely fund management, and you may be knowing the RBI guidelines also where it is a financial institution. So if it is a financial institution, again it is hitting me. So even if I am getting 7%, if it is a financial institution, then it is hitting me on LCR side, and if it is non-financial institution, maybe a development institution, then it is hitting me less on the total cost. So if I consider my LCR, how much I have to keep, so then it depends upon the situation when selective. That is what I said, that when we are talking about protecting the margins, we are looking on the all possible options which is available.
Understood, sir. Thank you.
We are running out of time. Maybe the last couple of questions.
Good afternoon, sir. This is Shubhra Petkar from Financial Express. I have two questions. First is, given that the Finance Ministry has been asking PSU specifically to focus, and banks in general, to focus more on the MSME and the agri segment, they want you to give more loans to that segment. So what are the steps that you have taken to grow in that segment, and also how much more can we expect growth in these two segments in particularly, maybe in the next year or the next 2 years? The second question is on the draft M&A financing guidelines that have come. Have you had a look at it, and what are the have you found any, what are the kind of suggestions that you'll be giving to the RBI before the deadline? Thank you. Also, why are the agri loans down? And the slippages are also, they're kind of up, so.
Regarding MSME funding, not only now, always we will be focusing on the MSME segment and continuously bringing out, like MD sir has told in the opening remark, that there will be a lot of cluster schemes, cluster specific schemes. We have been bringing a scheme, and some of the schemes have been revamped on a day-to-day, on a regular basis also. Recently also we have introduced 2 other schemes just to focus on MSME, and we also built up a infrastructure. If you look at it, we have a MLPs in all our regional offices. We have a MLPs who are sanctioning it faster disposal of the proposals, and also we have a UMP branches, that is a Union MSME First Bank branch. So we have been focusing. Beyond that, as you earlier also we told, there is a Nari Shakti branches have been there in 5 places we have opened it, which will be mentoring the women entrepreneurs in those areas, with more focusing on how to start a business, how to run a business. That also we have been doing. We have been nurturing with the MSMEs, and our continue to be focused on the MSME, because targets government has given to us is huge, and we are focused, and we are moving towards that. Today also, if you are looking at it, our MSME growth is one of the year on year, it is around 15%. We are showing that. So that is going to be the focus area. Next question, what you asked is about M&A. We have been discussing with our risk department. We will be shortly giving that to RBI. That we cannot be. We will be sharing that time when we are coming in the final guidelines. We will be doing that. Agriculture, it is more on, I will say, more on the seasonal things. It will not be. You cannot expect that to be in a very growth sector in a quarter on quarter. If not sequential, you cannot look at it. We are focusing. We have been brought out various schemes also. Very aggressive in giving agri infrastructure also. We are doing it. Continue to be focused on it.
So with that, we'll, call an end to our press conference. We thank you as always for your support. We look forward to seeing you next week.